In recent weeks, there has been renewed talk about the economy re-accelerating, not decelerating, re-accelerating, and the no landing scenario. Not just soft landing, because economic data has been generally good and above expectations. We've seen this last week. What do you make of this no landing scenario and possible re-acceleration?
You know, a year ago, a little more, there was a debate in the markets of like a hard landing, soft landing. These are somewhat nebulous terms and they're not necessarily well defined, but I think everyone knew that hard landing means recession, soft landing basically means no recession. I think that's a pretty straightforward thing. Now that the expectations are for like a recession is very low, it's this soft landing, no landing. It's even sort of more undefined what that means. And I think if we surveyed people in the room, say like, how do you define a soft landing? How do you define a no landing? We'd probably get about 50 different responses. So I like to actually try to quantify, like in some sense, like what it means. And a week ago, I wrote a note and I titled it the 5% landing. And by 5%, this is, if you look at the nominal growth in the economy this year, the first half, it's about 5% nominal GDP. In the first half is about 2.5 real GDP growth and about 2.5% inflation. On Wednesday, we'll get the first estimate for third quarter GDP. Tracking estimates are like 3 to 3.3% in that range. The inflation data we have for Q3 would put inflation around 2.5% annualized over the quarter. So rough approximation is that third quarter GDP nominally grew 5.5%. For perspective, the last 3 years, it was over 10%, 9%, and 6% last year. So when I think of a landing, I'm thinking, well, the economy is kind of landing to this level. I think the soft landing perspective is what we were pre-pandemic, where it was basically 4%. You know, you had 2% growth, you had 2% inflation, you had very low rates. I think historically that's the anomaly. I think we'll have something that's higher, if just because of inflation. So that I just try to kind of quantify what we mean. So I think we've kind of landed in this range, give or take, for the time being. Mm-hmm. On the acceleration, I think that's a little bit of taking 2 data points and extrapolating a whole trend line as opposed to where is the overall trend. My sense so far on the panels, I'm the bull on the market list, the relative optimist. I would pick up a point that Peter made in terms of like there's a lot of differentiation. It's important to acknowledge that. In simple terms, like on a global scale, there's the U.S. and there's everyone else, and the U.S. is doing well. The rest of the world is not doing as well. A week ago, The Economist had a whole section, talking about the envy of the world is the U.S. economy. Even within the U.S. economy, there's clearly kind of like a K-shaped kind of bifurcation. There's people who've done very well over the last 4 years, and other people who've clearly struggled. When you look at the overall aggregate statistics, at least for the consumer, and this is critical when you think about the economy because it's 70%, households in aggregate are in really good shape in the U.S. You'll get a lot of statistics like credit card default rates picking up, but the majority of debt that households has is mortgages. Most people locked in at sub 4% back in 2020, 21, so mortgage rates going higher has not impacted them. In fact, it's not a joke, but like this is reality. There are a lot of people who borrowed 30 years at 3.5%, and for the past year or so, been able to put money in money market funds at 5.5%. That's a pretty good trade for average households. So when I look at households, whether it's total wealth, debt servicing costs as a percentage of income, it's the lowest it's been roughly in 40 years. Real incomes are now rising. I've seen charts where people look at the price index, the CPI index up 23, 24% in the past 4 years. Median household income is up 24%, and it's actually now rising faster than inflation. So all this to me suggests that, again, in aggregate, the US consumer is in good shape. If they're in good shape, it's really hard to have much of a slowdown.
You've been actually writing about the possibility of roaring 20s, which you kind of touched upon. What do you mean by roaring 20s, and why do you think it's possible, if you can just kind of summarize it quickly?
So it's a macroeconomic story, but if you think about equity markets, the S&P 500 total return over the past 5 years, we're 2 months away from the halfway point of this decade, it's kind of hard to believe, it's 94%. That is roaring by any kind of definition in terms of just the performance. By the economy, I mean an economy that's going to grow 2.5 to 3-ish% in real terms, inflation somewhere between 2.5, 3%, so nominal GDP of 5, a Fed funds rate that ultimately probably goes to 3.5%, and the 10-year, say 4 to 4.25% is some sort of range like that. So to me, by that criteria, it is already meeting my definition. It's more a question of will this continue or not. And ultimately it comes down to the supply side. If we think of like 2010s, to me it was a demand side story. There just wasn't a lot of demand after the financial crisis. This decade has been defined by the supply side. First the pandemic dislocations, and now the question is, and I know we'll be talking about later on, like on the supply side improvements, whether unexpected surge in immigration and labor supply, AI is a supply side story. Ultimately, it's a productivity enhancing tool that shifts the supply curve about how much. So I'm not saying this will continue, but the conditions are in place for this. I kind of thought like the 1990 second half of that decade, that is at least on table right now. That's what I mean by kind of a roaring 20s.
Thanks so much.